Adam French, welcome on to Searching for Mana.
Thank you very much, Lloyd. Welcome. Happy to be here.
Pleasure to have you here. Adam French is the founder, Chief Executive Officer at Scalable Capital. Scalable Capital were founded around 2015 and over the last 5 years have become one of the leading European robo-advisors. We will walk through Adam's career, a graduate of London School of Economics, where he achieved a first-class degree in, I think, business, maths and statistics.
That's the one, yeah.
Around 2007. So another founder who joined the world of finance at crunch time a decade ago or so. Spent several years with Goldman Sachs. Ended up in a couple of directing positions, mainly focused on commodities and derivatives.
Exactly, yeah, that's the one. I can talk a bit more about that in detail, kind of trial by fire there.
And then obviously was inspired to found Scalable. So yeah, we will go through all of that. To start with, Adam, if you could be so kind to give us some context about where Scalable Capital is at right now and what you guys are up to, please.
Sure, no, happy to. Feels like a long time since we founded Scalable back in 2015. When we first started out, it was definitely focused on the robo-advice side of things, and we wanted to bring a solution to market that would help people get more access in a more convenient way and ultimately at a cheaper price point to investment advice and investment management so they could save for their long-term investment needs. But we've developed it a lot more since then. And if I look at the company today, which is about 140 people, yes, we're still doing the direct-to-consumer robo-advisory piece. But in that time frame, we recognized there was also a big need for the technologies that we're using at Scalable to be leveraged within traditional financial services firms to be able to provide the same services or similar services to their client bases. So since 2015, we're a FinTech, but we're also a tech business in that we're providing technology solutions to incumbent financial services firm in a way that when I look back 5 years ago, I don't think we ever imagined that would be a major core part of our business, but it has developed into that. So we're now providing robo-advice solutions into Barclays here in the UK for a new service they launched this year called Plan and Invest. We're powering the ING robo-advisor in Germany. We're powering in Spain, Santander have a digital bank called Open Bank, and we power all of the robo-advice solution under that. And there's many, many more as well, not just in the market, but also in the pipeline that we're working on today. And most recently, we've broadened out the scope of what we offer as a firm to our direct clients, the clients that we manage money for and that we give advice to, away from robo-advice, but now into the DIY investing space. So we most recently launched what we call a neo-broker, kind of an online broker within Germany. And that's for clients who ultimately want to do it themselves, but the incumbent offerings are very expensive. No fractional share dealing, you're paying 20 euros trade, and we're offering that for a flat fee. So we've most recently broadened the whole proposition out from one which started as robo-advice and wealthtech capabilities into now a fully fledged digital investing firm.
Thank you. So I've got a few questions. Firstly, let's go back to robo-advising at its dawn via Scalable. Why did the customer need that?
Sure. I recognized there was a need here, and my co-founders as well, when we were working at Goldman. And it's the type of seat, especially when you're in an investing role, in a trading role, where your family and friends are always asking for investment tips and advice on what they should do. And you recognize that there's not really many places that you can send them to that you feel confident that they're kind of going to be on the right path. If you've got less than 100,000, 200,000, 300,000 to invest, then good luck trying to get some solid financial investment advice. So you're typically going to be advising them to go and do it themselves somewhere, and maybe you're giving them an ETF or a fund recommendation for something that they should buy. And that's not the right thing for so many people out there that don't have their whole lives embedded in the financial world like I did. And there was a recognition that there should be an alternative to be able to provide that solution to people who don't have that much money to invest. But if you deliver at scale, it can be done at a much lower price point as well. We had in 2015 already started to see this type of business model arise in the US. So Betterment and Wealthfront were the two forefrunters of the robo-advice world over there. And it became quite apparent at that time that a solution in Europe was more than needed. And I've got a completely UK-focused background, so I understand the retirement problems that we have here today with the state and the corporate kind of pulling out in a big way into kind of what they're willing to invest into your retirement, and the individual having to make so much more of a trying to find their own feet and trying to fund their own retirement ultimately, with the reduction of defined benefit pensions and more of the proliferation of defined contribution. That's happening globally. That happens in Germany. That's happening all over continental Europe, where we have a footprint. And so it was the kind of early conversations with my family and friends and with my co-founders that this isn't something that was just relevant for the UK, but something that we could actually scale across Europe as well. And so, yeah, we decided back then that we would give it a shot.
And when you embarked upon that, the feedback was positive. There was a demand for this. Then when we come to the business model now, you're scaling into different tranches of the business. Why aren't you just capitalizing on taking the robo market?
Sure, no, very good question. I think one of the most important things you're doing when you're starting a new business is focus. There are so many things that I would love to get involved with. We could have easily from day one said, well, there are some clients that want to do it themselves, and there's a need in the market to be able to improve the current offering that people are currently using. It's too expensive. They can't access many elements of the securities market. So, for example, ETFs are not very readily available on the current DIY platforms, or at least they weren't 5 years ago. But we needed to focus on one single client need, one single target user base that would love what we were building for them. Because if we built something a bit too broad and a bit too generic, then we would have built something that people like and they kind of get, but we haven't got those advocates. And so we fully focused on something where we knew there would be a proportion of society who they don't have enough time, or they don't have enough money to invest either themselves or through a traditional financial advisor. And they would see our solution and go, you know what, this is exactly the solution for me. And that was our full focus for 3-4 years. And it continues to be a core part of the business. The move kind of away from focusing just on kind of our own client base and servicing the financial services firms as our B2B clients came through inbound requests in the beginning. So it was only 2017 when we started working with ING, just 2 years after our foundation. And they were looking to launch a robo-advisor themselves into the German market, saw the early success that we'd had with our client base, and took a decision that they would partner with us and use our solution for their own clients. So it was in a way it was a B2B2C, because we were ultimately the robo-advisor of ING's clients, but we were delivering it through the ING infrastructure, so in their apps, in their online banking. And it became obvious that this was an area that we seemed to be quite good at. We seemed to be able to integrate with financial services firm. We were able to implement. We were able to get our two cultures to work together, which is a big challenge with B2B FinTech. We have a huge organization with a lot of governance and a small startup trying to work in a very agile way and trying to make those two things happen. It can be hard, and we seem to be able to do it. We've now done it about 8 times with different banks. And then it became apparent that there was a need further from the infrastructure that we built. We built a lot of the technology and the operational staff and the servicing staff to help our client base. And it became apparent, well, why don't we take that infrastructure that we have and build further solutions on the Scalable brand? And the most natural place for us was on the neo brokerage side. And that's our first move away from kind of the traditional investment advice and investment management space. and probably the first step of many, many more kind of broadening out of our capabilities over time.
And Adam, if I try and understand how you were capable to both run what is in essence a startup financial advisory business and then also a technical platform, your founding team, what was the makeup that afforded that?
Sure. So there were four of us. So myself, with a trading background, quite an interesting desk actually that I worked at Goldman. So maybe I touched on that for a moment, because two of my other co-founders worked very closely with me in that kind of position at Goldman as well. It's actually one of Goldman's only, ignore Marcus, and Marcus is a relatively new thing, but let's go back 7 years when I left, and in the 7 years previous. I worked on a desk called PIPG, Private Investor Product Group, and it's a desk that not many people know about, but that desk faces off to retail clients in continental Europe mainly, and to the private banking world and to the financial advice world by basically structuring and trading a variety of structured products, if you will, derivatives, to ultimately end up into the hands of a retail client, a regular client on the street. And so that desk is unique in Goldman in that you're one of the only kind of places within the whole bank that was dealing with a retail client and not a professional client at the end of the day. Now that all of that's changed with Marcus, obviously, but back then it gave us a lot of insight into how the retail market worked.
What level of net worth did the retail customer have to be?
So for some of the products, very, very little, because they were traded on exchange. So we had about, maybe fuddling with the numbers because we're going back quite a while now, but I think between 50 and 100,000 investment products we made markets for on exchanges across Europe. And if you went through a broker, so there's many in the US, in Germany, but if I kind of use a UK example where there wasn't actually much of a footprint, but if you went through a Hargreaves, for example, you'd be able to trade a Goldman Sachs structured product that we were making markets for. But we had a much bigger footprint in continental Europe than in the UK. And it was through that you made a lot of learnings about kind of client behavior, what they wanted, what was popular, what wasn't popular, and you also were marketing to those clients as well. So trade fairs, investment fairs, you had Goldman presence at the investment fair, and that wasn't the seat that I sat in. I didn't sit on the marketing distribution side. I was on the trading side. But you had to have a good understanding of what clients wanted, because you need to make sure that you had the right product set available, that you understand where the flow is going to come from, and it's quite, that kind of education is quite unique. That kind of led us to then leave Goldman and kind of move on to.
So that was you, two other guys on that desk, three founders, and then the other founder.
The other founder is an academic, so he's a professor of econometrics at Munich University, a little bit older than myself. Amazing guy who in the beginning really brought to the table the gray hairs that we didn't have.
How did that even become a situation?
Sure. So one of my co-founders, Eric, who I met at Goldman, he had also a very interesting career path. He left a few years before myself, and he joined an e-commerce startup in Germany called Westwing. Westwing is kind of it's all across Europe. It doesn't have any presence in the UK, but they're a shopping club where you put your email address and then you receive a daily newsletter with mainly furniture and home and living stuff.
That was an off-piece career move.
Yeah, completely. he moved into a very senior management position there, and I think that was great learning for him in terms of how an online business would work and how you could scale a business. It was a very successful business in the online space, funded by Rocket Internet, etc. So the link then back to Stefan, the professor, is it was his professor at university, and he just kept in touch with him. Stefan's background, away from the academic side, was he was also advising asset managers and central governments in terms of how they could manage risk, and how they could use risk management techniques to provide a kind of a more smooth investment style profile with regards to how you would manage a portfolio. Obviously very interesting for how we might be able to take that into our own portfolios, which we did, and it was kind of our unique selling point for how we were managing money by using passive building blocks, but having a big focus on risk management. He was central to the foundation of that kind of the investment side of our business.
But there's no one who's a dev or a CTO or a technologist here.
No, not in the original team. And so we brought in external individuals. Some of our earliest team, I'm thinking ex-Google, and then our first CTO came in about a year after we founded the business, and a chap called Andreas, and his background was a core banking provider, Avaloq. So kind of came with the enterprise side of what we're now doing on the B2B side, which is very interesting. But then he moved away from that to head up the mobile development for the travel tech company called Get Your Guide, which is big in the when you go on holiday, you book tours through them, and they're doing very, very well, or at least they were pre-COVID. Not sure what's going on now, but obviously a challenge or two there. But he brought, again, a very unique set of skills to our business, where he understood how to do mobile, how to do new tech, and then how to work with big banks with their technology governance structures and how they think about technology deployments. And so it's been instrumental in the development of the technology stack that we're using at Scalable. And yeah, I remember those early days in the office. There weren't many of us, but they were mainly devs. Devs were 75-80% of our initial new hires. And even today, they're about, including the product team that sit very closely with the dev teams, because we work with an agile framework and whatnot, full stack teams. That's over 50% of the business is development.
And how many staff are you today?
140 today. And so if you look across the product and engineering groups, we're talking about 60, 70 people and upwards. And if you look at the careers page on our website, we need more devs. That's like the one thing that we're pushing for.
Fantastic. Let's talk about that. Adam, just to finish the picture on Scalable, if you don't mind me asking as well, a large part of this, of course, is fundraising. Today, you've raised how much in total?
I always forget in which currency, but it's just shy of about 100 million euros, I believe. Yeah. Right. Latest round was.
When we go for your journey, I do want to talk about that, because a large part of the audience will be fascinated with the trials and tribulations that come with that.
Sure.
And then also, it sounds like you've got really big clients. It sounds like you've got good market share. Where are you in terms of revenues, profitability?
Sure. Fully focused on growth still. As you can imagine, a business like ours takes a lot of upfront investment to bring clients on board, but the clients have a very long lifetime value with you as well, because the typical period in which you have an investment relationship with a client runs into multiple years. Still seem to be, we still need to learn how many years that is, because we're still a young company. But we can estimate that most clients stick with us for, let's say, 5+ years. Which means that we're willing to invest quite heavily into a new client and bring them on board, because we know that over time that the revenue that we would generate from such a client will pay for that. So it means that we're continuing to raise to fuel that growth. And yeah, for us in the last 3 years, things like revenues have increased exponentially, as has our client base. And we're still hiring heavily, investing heavily into everything that we're running internally, into our marketing, etc. So profitability isn't something that we're not there yet, but it's also something that we don't really look for at this stage.
I'd like to change it up now and actually go back to formative years. When was the moment that you first started thinking about the shape of your career?
Yeah, very interesting question. Going back to school, let's go back many years now. I was brought up in the northeast of England, went to a state school.
Whereabouts?
In Newcastle, actually, although my accent doesn't give me away anymore. My mum hates me. When I came down to London, and as you said, I went to London School of Economics, for some reason my accent at that point onwards seemed to get a bit mixed. And I work with a lot of Germans and a lot of Americans.
Yeah, it's such an international school, isn't it?
Yeah, and now it's very, very hard to work out where I'm from. But I have Geordie roots, and yeah, kind of coming from that background, for some reason when I was in school, I always wanted to come down to London. Always wanted to be a big part of the big city. And for me, when I was kind of selecting where I'd love to go to university, my number one choice up there was London School of Economics. There was no Oxford or Cambridge in my mind. It was all about trying to get to London. And I was fortunate enough to be very good at maths in school, and so focused on that throughout my whole university career. As you said, I did a course in business maths and stats, and the reason why I did that, it's kind of a unique course. Not many people would tell you that they've got that university degree from other universities around the world, but it's a course ran by the statistics department at LSE, and one of its primary focuses is to give you a buy on the first set of exams that you have to do to become an actuary. And so for me, my first port of call when I came to London was I'd love to be an actuary. And that's why I did that course. Bit of a random want as an 18-year-old from Newcastle, but that was what it sounded really cool, sounded really interesting, what they do. And then when I was at LSE, kind of got my eyes open to the broader world of financial services and what else was out there. And at the other end of Fleet Street was a big bank called Goldman. And like every LSE student in the second year of university, you apply to every single bank to do the summer programs. And I really wanted to be on the sales and trading side, and really, really cool program that Goldman ran in the summer, where you actually join the division and then you can completely rotate around that division, and you can learn about what lots of people are doing and where you'd ultimately, enjoy spending your professional career if you're lucky enough to get an offer.
At that point, what's driving your appetite to be interning on that scheme? Because if you've got maths and statistics as the primary skill set, and your eyes have been opened up to economics, then it's not the obvious thing to look at. It's not potentially looking at something more quantitative. Why was that? Why did you think? Actually, the question here is, what drove that decision? Was it you'd already started thinking commercially? Had you started thinking, okay, this might be where I earn the most? Had you started just becoming fascinated in it?
Yeah, if I'm being brutally honest with you, I was relatively driven by money in the early days, it doesn't take too much research to work out the opportunities in trading desks at places like Goldman, what that might mean. And I think it has a lot to do with my upbringing from a single parent home in Newcastle. Ultimately, the back of my mind thinking, I want to do better and I want to improve on myself and kind of take our family to the next step. And I'd kind of seen that through my grandparents' generation and through my mom's generation, this improvement on lifestyle. And I definitely wanted to kind of take that to the next level. And by being good at maths and statistics, I think that was kind of a lucky platform to be able to then work in financial services, which is a fantastic place to be able to then provide some self-financial freedom. So that was 100% the driver in the very early days, going back to when I'm like 18, 21 years old. And the opportunity at Goldman from the internship was to be able to basically see a wide range of desks, from the very flow vanilla side where it would just be market making stocks and shares all day, not as quantitative as you were mentioning, all the way through to those quantitative structuring desks. So you got the whole breadth of opportunity of kind of what would you like to do, and there were elements of everything that I enjoyed and elements of everything that I didn't enjoy. And the desk that I ultimately found myself on, this PIPG trading desk, it was an equity derivatives trading desk ultimately. I took that decision because of the people. I really enjoyed the people that worked on that desk. I could see myself working with them for 12 hours a day. And a piece of advice that I still give today to young individuals joining big enterprises like that have the opportunity to, they might get like, oh, should I join commodities trading or should I join equity derivatives trading? It doesn't matter. It's the people who are there that ultimately matter, because you are spending more time with them than you will your wives and friends and people within your family. So enjoy the time you spend with them.
So when you ultimately land the full-time role at Goldman, And then after the pinch yourself moment, this is for sure one of the firms to go bag a roll at if you're focused on finance. Like you say, from a family perspective, I assume everybody was incredibly proud of you at that point, Adam. You go into the reality of the role. You're getting along with the team, there's intellectual stimulation, etc. What were some of the most challenging things for you to be successful at Goldman's in those early years?
So the world changed from my internship to the time that I joined. I was in New York from August, September 2007. And at that point, there was stuff happening in the US housing market that, we hadn't played out the full financial crisis at that stage, but it didn't look as promising as it probably did a year before. And I remember coming back from New York and kind of joining the desk, very excited, and you could tell that the stress levels had changed. And that played out for about a year until Lehman Brothers went bust. And then probably a year thereafter where it was all hands on deck. Anybody would pick up any piece of work that needed to be done. It was absolutely nuts. And I remember there were times during that period where you woke up in the morning kind of numb from the day before because you were just completely worn out from everything you had to deal with, all the fires that you were fighting. And you had to do the whole thing again. And there were days where I thought, am I going to actually survive this day? But what a fantastic kind of opportunity in terms of learning. And I think that generation of individuals that went into the financial markets, 2006, 2007, 2008, 2009, there's probably a special breed of us there because of what we had to experience in our really early days. I think, unfortunately, that actually led a little bit to my downfall with regards to wanting to leave, because if I kind of go forward to 2011, 2012, when I kind of had in my mind, maybe I want to try something else.
And sorry, at this point, you have been promoted a number of times into director role.
Exactly. So you go,
which is no mean feat.
Yeah, it's it's the standard route up, if you will, but not everybody makes it. I really look back at those years with a lot of fondness. Goldman is an incredible place. Amazing people to work with, amazing focus, amazing culture ultimately, and what led me to leave and found Scalable with co-founders from Goldman. But by that time, the market volatility had gone to zero. And I do think that has an influence in the way that you think about your day-to-day job, where everything was nuts for 2.5 years. And then you're coming in and going, what's going to happen today? Nothing. And you were fighting with clients to think, okay, here's a great idea.
I've heard this so many times from that peer group. You had an introduction to what felt the most like a disruptive startup, almost.
Sure.
And then when it became more consistent, you'd caught the bug.
Yeah, I 100% agree with that. And I think that, as you say, that vintage of new starters, grads, I think everybody has that same frame of mind.
One of the things that I seem to, for sure, see as a trend in a number of the successful founding teams within the fintech market is that they're from Goldman's. Mm-hmm. What is it about Goldman Sachs that has enabled that?
Goldman is very entrepreneurial. You own your own space. You have to drive your own business. So even though I was a trader, for example, I did have to work closely with the distribution teams, to those teams that even went to the investment fairs and would market the Goldman brand to kind of understand, okay, what do I need to do in my role to make this a end-to-end successful business? And ultimately, it's no surprise, but individuals at Goldman, very smart people, very driven people on the whole. And I think that you've just got an incredible pool of talent, and people seem to get all behind that kind of singular passion or purpose of what the business is trying to achieve. Obviously in a kind of a completely different way to what now we're doing on the fintech side, completely different client base, completely different vision for what we want to do with our firm. But it feels like in that firm, you have everybody driving towards the same mission-orientated goal.
And each desk is, in essence, in a way, learning to run its own business.
Yeah, exactly. Very entrepreneurial, but also interconnected in a way. So there is a complexity to it that you need to understand.
Because you see this also from a few of the best strategic consultancies, such as BCG, Bain, McKinsey, it's an incredible place to go and work for a few years, several years, and then go raise money and found, because you've typically been taught how to manage a business internally and also network.
Exactly, and it's your atypical meritocracy. So you need to deliver, and you want to deliver, and everybody's kind of thinking on the same page in terms of their own little business. It does mean that there's a lot of politics ultimately towards the top, and I'm so glad that I don't have to get involved with that because I saw it. I could see it while I was at Goldman. If there's two people in one seat, it doesn't usually end well for one person. But no, that learning ground, that opportunity. I feel like I learned more actually at Goldman than I did from university.
So we're just for the last time mention Goldman. we're coming toward the point where you decide that you will leave and you'll found Scalable. Let's really try and dig in there. There's a number of things, and I want to go back as a headhunter would into your drivers at this point. So you're in a position now where you're being paid well. There's a level of prestige. I'm sure family are proud of you. Maybe the advice would even be, hey, stay there, Adam, right? Everything other than just staying there is a risk. It's where is your risk set? And yours is that there must be something else at this point that is a bigger driver to make you take that risk. And so just talk us through that moment and that story when you make that decision.
I made the decision to leave at a lunch which lasted 8 hours with one of my eventual co-founders, Florian, one of my ex-colleagues from Goldman. And we were discussing the idea. He'd already made the decision that he wanted to leave. We'd spoken for about a year previously, a multitude of different business ideas, just to keep ourselves kind of intellectually engaged. I remember one time spending an afternoon with him trying to work out, should we launch an airline? And we did a financial model for it, just on the fly, like pulling up EasyJet financial reports. We were just a little bit bored and just trying to challenge ourselves intellectually. And he told me he was leaving, and I said, we've got to grab lunch and I want to understand what your ideas are here. And he told me that he was leaving to basically try and kickstart this idea, the whole robo-advice idea that we'd also been discussing. And we talked about it for about 8 hours. There was a few drinks involved, as you can imagine. And by the end of that lunch, I had it in my head that I wanted to do it. But I had to convince my wife first. And that took a little bit longer in terms of the convincing. But you're right. Goldman gave me the right platform to be able to say, you know what, is it a big risk? And it felt risky at the time. At the time, people were saying this is the biggest risk you could take. You've got a comfortable seat, as you're saying. You're on the right career path, the right trajectory. Why give that up to risk everything, essentially? There's touch wood, we're still in a good spot with Scalable, but in those early days, it could have been completely fruitless and waste 5 years of your life with nothing to show for it. At the time, it felt like that, but now, actually, when I look back, maybe it was the complete opposite. Maybe the riskier thing to have done would have been to have stayed in that seat, to not really have grown much, to have kept my skill set very specialized and kind of sat in a place where, yes, I would have become more of an expert in that very, very narrow niche. But if the world changed, and I don't know, how well people are doing in the seats I used to sit in these days, but the world is changing in a big way. I see that, doing what I do on the digital transformation front. What I've now exposed myself to was maybe the least risky thing I could have ever done by broadening out my skill set. And I like the concept of the T-shaped person, where you have a broad set of skills and you have a lot of specialism in one area. I feel like I'm creating that of myself now, and I'm very happy to have done that through founding Scalable. So it felt risky. Some people kind of joked at the time, you just like doing this to yourself. As soon as you get yourself in a comfortable place, you kind of you pick yourself up and do something new, and maybe that's who I am, kind of deep down to the core. That I always have this need to want to learn something new and to challenge myself in a different way. But the opportunity seemed fairly obvious as well.
And your initial hypothesis, which would have been put together in a eloquent deck and then courted around investors, which of course you then raised. What was the initial raise?
The initial raise was about $1 million. Forget if it was.
How long did that take to raise?
Quite a while. It was challenging.
And you were doing that having left Goldman and now
exactly.
before you guys were set up. And at that point, beyond the deck and Excel forecasts, was there anything fundamental in the business? No.
Absolutely nothing.
So it was, of course, for very eligible to be invested in individuals with a really good business plan. And you were pointing to America and the couple of examples that had already got going, saying that there's a market opportunity here. Took some time to get that raised, got the £1 million. And then some of the first things you do is you hire some development individuals.
Exactly, and go on what's probably the biggest challenge for an early stage startup in the fintech space is go through a regulatory approval process. So we chose to go for both BaFin in Germany and the FCA in the UK so we could hit both markets at the same time. And so our first year was spent developing in the background, but ultimately unable to service any clients until we got the green light from the regulator that we could do so.
So from founding to through the regulations took how long?
That was a year.
That was a year, and you had an MVP, a usable product in what time frame?
We could probably have launched in the summer to kind of September time of that year. So we founded it in basically the start of 2015, and we were we got the license back end of 2015. We could have probably started with clients in, let's say, the August, September time.
And the moment that trading was operating through the platform, again, is another, this is a seminal moment for you and your founders and Scalable. What happened? What was the moment that for the first time you had a product flow?
So we launched in Germany before the UK because we happened to get the license there first. And when we kind of launched the business to the world, it was before we were ready to open the platform to everyone, but we had good coverage in the national press. And we had a waiting list, and we already had about 10,000 clients on that waiting list before we opened the gates, which meant that when we had an initial client base that we could manage money for, but we also kind of knew, okay, there's something there, and let's trickle it in at the beginning and see how it works, see if all of the pipes work, and it did, and then we opened the whole thing up. And back then, a couple of tens of Ks a day was interesting for us, and now that can be 10, 20, 30 million on a given day of inflows. It's funny when you look back then at what you kind of celebrated, but that's true of many business journeys. But what was the interesting learning was, and it was a good learning to make. We obviously had a lot of friends and family that were like, yeah, as soon as it launches, I'll put money in. And then we launched, and it was like, okay, it's ready. Are you ready to put your money in? And they'll be like, yeah, soon. So no friends and family. Well, a few did, but not as many as we thought. And
that might be a good thing when you're at the start of your product. Just like
yeah, and it was because that meant that the clients we were getting were people that didn't know us.
These were real.
Yeah, these were real clients that had to trust us as unknown individuals, and they were. And so that was when we kind of, I guess, saw at that stage, there is something really here, because we can't experiment in the fintech space like you could in the rest of the tech world, where you could put an ad up on Facebook and have like a landing page behind it, and if you get 10,000 people click on the ad, you think, oh, well, you know what, I'll build the product. It looks like there's demand there.
I was thinking coming into the interview, Adam, it seems like an obvious solution now, and then if you go back to when you at the dawn of presenting this solution, I wondered if the number one thing that you needed to achieve was trust. It all focused around that, and to have, I think you just say, thousands of people queuing up to use the product. You must have, of course, achieved that. How did you achieve that?
It was a seminal moment, if you will, because up until that point, we just didn't know. You kind of had, that was the hypothesis ultimately, but until you get that demand coming through, it was all just a pitch deck up until that point. And we focused on distribution. This is the type of thing that ultimately doesn't sell itself. You have to go out there, and people need to be aware of it, and focused in a big way, particularly in our early days, on all distribution channels that we could possibly, get access to, and work out which ones work, which ones don't. And we were typically seeing it kind of fall through.
Sorry, when you say distribution channels?
So different ways to market the product. So paying for advertising in newspapers, putting radio ads out, social ads on Facebook and LinkedIn. So we put a large marketing team in place. We hired a CMO relatively early on into our business. So she was in place before the product went live, set up the complete marketing structure, the KPIs, kind of how they were going to test and learn.
What was the most successful distribution channel?
So it's the answer is there isn't one. It's persistence, and it takes a lot of time to build that trust with clients, and you have to manage them through the funnel. So if you kind of get your first exposure with clients through, it could be an ad somewhere. Let's say it's a magazine ad, or it's a TV ad or radio ad. They might come to your website, or they might see you in a second place and then decide to come to your website. But you need to have multiple touch points. And then when they are in the funnel, once they've decided, you know what, I'm going to do this, you need to manage them through that onboarding process, because it's not as viral as kind of, signing up with a login with Google button and they've got access to everything. We need to, check their financial situation, give them advice, right? You need to, take a lot of details from them. That's a long onboarding journey.
A lot of the neobanks very much attracted people by bringing them into the mission. So, okay, banking is broken. We are trying to fix this. Come and become part of our community. We will take your feedback and let's build a bigger bank. Scalable Capital's mission statement is to democratize wealth management. What are you advertising at that point? Were you buying them into the mission as much as you could make money, or actually in your world, wealth, it was more with your level of high net worth, you now have access to what you wouldn't with traditional brokers?
It's a little bit more challenging on the robo-advice side than what we've seen on the neo-banking side. It felt like there was a very natural tribe for them to go after, and a large tribe as well. And Monzo did a fantastic job at being able to mobilize, at the end of the day, hundreds of thousands of clients that could get behind their mission with a relatively limited product set in the beginning. Not even being a bank ultimately, but just an e-money card. And I think they're fantastic, and they're doing. They've got a great product range these days, and I'm a client. But for us, we had to take a different approach, because the investment community is a little bit more undercover. People don't actively talk about who's managing their money, or like how much they're worth, and they might talk about stock picks, but that's a different target client base to ourselves. That's the neo broker client base that we're now going after. So a slightly different marketing approach for that type of target market. But we found that few different things resonated with different people. So that we got the people who want to save time, and they're the people who the messages around, it just takes a few clicks and you can do it on the go. Those messages work very well for that type of individual. But then there are others where it was actually more about saving money, and people who understood that if you're paying more to your advisor, then you're not actually investing that money in the market, and ultimately that money won't grow.
But is that really significant? So, if I want to pick an equity with Hargreaves, for instance, it doesn't cost much. And so if we're trading at or into the thousands, that's a real USP.
Yeah, 100%. Okay. So just take the example on the neo broker side. So in Germany, you can pay us about 30 euros a year, and you can do unlimited trading. We don't charge you anything on top. Whereas Hargreaves, I think it's about 20 quid a trade or 15 quid a trade or so, depending on what instrument you use. But you're probably talking about a 10x price difference, which seems to be well recognized kind of difference in price point.
So we've got when people price move as part of the disruption. We've got efficiency.
Yeah, I guess convenience.
Lower touch.
Yeah.
We've got trust potentially playing in as well.
So that's one where we've got the the USPs of or at least the value prop of saving time, saving money. What has to come over the long term is this trust element. People don't see the company and go, you know what, I trust it now. That comes over time.
And also, where can you get the better returns, I suppose?
Exactly. And we're a new company. You don't know You don't know what that possibility is with Scalable. So that takes a lot of effort, and that is hustle. It still is hustle to this day to do that. And we even run webinars, seminars in front of clients. We have an active sales force that are reaching out to high net wealth individuals who have shown interest in the business. And yeah, you fight for every client, and I quite like that.
So Adam, we're through that initial raise. We have regulations through. We have product. We're starting to hire. Incredibly exciting times. You've looked at the various distribution channels. You've come up with what marketing works best there, and then you're also looking at overall how can we be trusted with people's money. At this point, you forge strategic partnerships, I think, with BlackRock. Seems, I suppose, now obvious why you might do that. But this is quite early on in FinTech. That's hyper impressive to get at that point, and must have been, again, another one of the seminal moments. Just talk us through that, please.
Sure. We'd known BlackRock pretty much from the foundation of the business because we are a user of some of their products. As world's largest asset manager, they have a very good selection of ETFs that we were using in the portfolios. So we always had a relationship with them from the get-go, which is ultimately what you want when you're trying to work with a strategic partner. Them having a good understanding of your business and you having a good understanding of them, and we got that. From the BlackRock point of view, I think what made a difference for themselves was so early on in our journey. We launched in back end of 2015. By 2017, we were launched with ING as a B2B partnership. Was their understanding that we got it from a B2B point of view, because ultimately BlackRock is a B2B player. They don't have a natural distribution channel with direct clients here in Europe or pretty much anywhere globally, and so for them, this play was around, getting this technology into the hands of the major distributors of financial products around the world. They had previously bought a business called Future Advisor in the US, so they had experience of investing or kind of bringing in investment technology, wealth technology on the US side of things, and they were looking for a similar solution to do Europe. And so we'd been having those conversations, in the background for a while, and they were very impressed, one, that we got B2B and we did it so early, but two, that we executed on it. Because it's not easy integrating a startup with an incumbent financial institution, and we were able to do that. And I think that culturally, because we'd done it so early on our journey, we'd set up the business in a way that could both do direct to consumer, but it could also manage enterprise financial services contracts. So I think that was really important on our kind of path towards B2B. So they ultimately decided not to acquire us like they had done in the US with Future Advisor, but to take a stake in the business and to continue to let us to grow independently and to keep doing what we were doing so successfully thus far in the journey. But they became a huge financial backer, becoming a shareholder in the business, and ultimately an amazing strategic partner, because as the world's largest asset manager, they have access to the world's largest banks, the world's largest insurers, and we were then able to have the conversation around how could Scalable help you to launch your own robo-advice solution, and that led to many of our B2B opportunities that we've either launched or we're in the process of launching. So I couldn't actually think of a better strategic partner, really, and it was an amazing day, actually, the day that they had very senior executives flying to Munich, where we all sat around a table and we prepared a full day of kind of pitch deck and business update, and they were making a decision if they were going to go ahead with the investment. And the senior executives had an opportunity to tell their story, and there was one individual who's been there pretty much from the foundation of BlackRock. And you realize they're actually a really young firm. You feel like the world's largest asset manager, it should be 1,000 years old. It's not. It's about 35 years old or so, maybe a little bit older, but no more than 40 years old. And so you kind of recognize that their foundation and our foundation were really similar. Theirs was about leveraging the technology they had built in-house to provide that to partners through their risk management solutions. They weren't just an asset manager. They were almost as much a technology firm as they were an asset manager. And hearing the stories and hearing the growth and hearing the foundation just felt like there was so much synergy in the culture there. And so, yeah, it was actually an amazing day to listen to those stories, hear where they were coming from, and recognizing, you know what, this is going to make total sense to do this.
And so you have now somewhere around several B2B partners. The appetite there is you can't just go get, you know, a high volume of partners, right? It takes a huge amount of your time. I'm assuming you need to be very strategic with it. But the plan there would be what? How do you see that scaling? Or are you happy with the amount of partners you want to build into them?
We're definitely going after a few large partners. There is the opportunity, and there are firms out there that cover that market quite well, to go after the mid-market and to provide a less bespoke platform and less bespoke offering to those clients. But we want to go in and work with the biggest and spend time and to become true partners rather than vendors of these big banks.
Because we've had on the show a few people from the space. Ned, who is the CEO of Bamboo in Singapore, if you know him.
Yeah,
know of them. Said just the appetite, so they're B2B.
Yeah.
The appetite is huge. You know, business development for them right now is their pleasure. Their competition, what's the differences between your business, or is this market is just such a huge opportunity many can win?
Yeah, I think it's when you look at financial services, there's always you're even competing against your partners in certain areas. You know, most firms are so big that there's areas that you're both competing in. It could be a bank that has an insurance arm. The insurer, you know, they're partnering with another insurer for some other business reason, and they're competing somewhere. So it's always hard to kind of directly say, yeah, they're competing with us. But I know Ned, and then I've met him a few times when he's been over in London. And yeah, Bamboo have a fantastic footprint in Asia, where we have a limited footprint right now. Not to say that we forever will, but and they seem to be on a similar journey to ourselves in terms of we see no shortage of demand for big organizations needing to digitally transform their businesses. I think there's been a lot of, and we probably see that more this year than ever before, because there's been a lot of effort gone in from these organizations to say that they're transforming without actually doing much transformation at all. And when you look at their core systems, it's still a hodgepodge of old tech, legacy tech that needs deprecating. And now they're recognizing with things like COVID and remote working and the ability to talk to your clients remotely and to deliver solutions for them remotely out of branch, that they recognize, you know what, we don't have anything that works for that client need right now. And so we've got the opportunity to go in and say, you know what, we can take what we've built and we can build the same for you. And I think the scalable USP versus a lot of our competitors in the B2B space is that we're not a vendor in that we're going to build something for you and leave it for you to manage. We also have a wealth of expertise on how to operate a robo-advice business, what works, what doesn't work, how to market it, going back to what we were talking about earlier, that we can provide to our clients as part of a playbook and say, this worked for us, and we recommend, you know, doing these things, operating in this way. This is how you should staff it. This is how you should govern it. This is how you should market it. This is what the investment vehicle should look like. And so we can help them not just build, but then operate this whole thing. And that's a true partnership.
And Adam, we had Joe Parkin on the show. You know, Joe, you dealt with him on a daily basis.
I'm aware of it.
That guy. Now, I know that he and BlackRock fulfill Nutmeg's portfolios in some instances. This is all not current time, but previously, let's just say. They're doing that with you also. And therefore, what's the differentiation if one of our audience wanted to select, shall I use Scalable, should I use Nutmeg, etc.?
Yeah, so we all have a different philosophy when it comes to how we manage the money. Yeah. So there is a uniqueness in how we all present that story. I think what we all agree with is that passive building blocks are the best way to go. And ultimately, if you are able to put more in terms of a cost point of view, if you're able to save more money in terms of the building blocks, you can put that money back into your client's hands. So there's a lot of commonalities, but there are kind of differences as well that we all tell through our different stories. We actually remain at arm's length with BlackRock with regards to our own portfolios, because we don't want that conflict of interest between having a shareholder on the one hand in the business being seen to be influencing our investment decisions. And so we keep those things completely apart, as we should. It doesn't mean that BlackRock aren't in the portfolio at all. As I said, the world's largest asset manager. It's only natural that they have a good product selection for us to then use as vehicles into our portfolios. But what we do leverage their capabilities for is more on the B2B side. So the open bank solution that we have in Spain for Santander, the portfolios in that instance are, or basically, it's not managed by BlackRock because ultimately the governance is such that Santander take the responsibility for those portfolios, but the products themselves and the mandate for the investments is outsourced to BlackRock.
So having a look at not the wealth tech space, but looking at what trends, which you'll be deeply looking at, going to be positive ones to invest in. The buckets that you might want to put your building blocks into, digital, the battery space, etc. Talk us through how you see that over the next few years.
Yeah, so I'm going to completely take off my scalable hat for a minute because of obviously our investment philosophy is broad-based public market investments and tried and tested solutions, if you will. And so the following is not a recommendation, if you will, as to what we would do from a business point of view. But what kind of interests me? Where do I kind of see emerging technologies or themes coming out? A couple of things. So one being, and it is still related to the financial space, but the whole topic of ESG. It's a bit of a buzzword right now, being able to invest ethically and socially responsible, but it is changing the way that all investment firms are ultimately looking at stuff. We just launched ESG portfolios. All the asset managers are putting ESG tilts on their portfolios, but kind of putting ESG kind of direct investments to one side. The other space that interests me is the tooling required to make decisions around is something ESG or not. So right now there aren't a lot of good capabilities out there to be able to pick up and say, is this stock or is this solution ESG appropriate?
And would the tooling be some type of analytical insights that you draw out of the fundamentals of that business, or does it need to be regulated?
I hope the former, but sometimes it needs the latter. But I think that the demand could be the pull to make the industry change. And I think we have started to see that. When we founded Scalable, ESG wasn't even a topic. We wanted to do it, but there was no liquidity. There was no real way to go about doing it. Now, in the last 5 years, that whole topic has turned 180. And now there's good liquidity in ESG-rated products. There's a demand for it, so clients are picking it. They're asking for it. People are constantly talking about it. So a lot has changed.
It feels like it's not just temporary marketing, doesn't it? But people who I know well who are marketing financial products, that's probably the number one thing that they're passionate about, and it's genuine. So first and foremost, that's awesome. Yeah. Isn't it? Let's build into
100%. I'm very proud that as an industry we've been able to make those changes and continue to make those changes. And there's still a long way to go, but it's happening, which is great. So I've got one eye on not just kind of the ESG investments themselves, but stuff that enables ESG, as you say, the tooling, if it's screeners, or it could even be around. So I'm a big fan. There's a business. I'm not invested in it at all, but I just love it as a business. It's an e-commerce place on the fashion side called Asket, A-S-K-E-T. I think it's from Norway or Sweden, and they have full transparency on their full supply chain. Things like that. I think that we're going to be moving more towards to have an understanding of where are the stuff that you're buying actually coming from, and holding people accountable for those decisions. I think we'll see that happening across all industries, not just the financial investment world. The other stuff that's I think quite interesting is, and I kind of started to think about this most recently, is the oldest millennials, if you will, turn middle-aged in about in the year 2030. And so the whole concept of technology being for the youth, I think, needs to be kind of completely turned on its head in the recent future, because there will be required tech solutions for that complete generation as they approach middle age. And if you think about the current middle-aged generation who are engaging more and more in tech, but there's still so many archaic ways in which the world operates, I think you're going to see massive transformation across all industries that deal with, what used to be kind of the laggards when it came to technology. They're not going to be laggards anymore. They're going to be looking for the same solutions that they had in their 20s and 30s when they're getting closer into their 40s and 50s. And I think a way that you can play that, I don't know yet, but I think that's something that's worth looking at as we kind of go into the next decade or so.
Adam, thank you so much. What a fantastic interview. And you're doing clearly brilliant work, and it truly sounds like the most exciting times for you moving forward as well. Huge congratulations. Is there anything that you wanted to just finish with for the audience?
I think that if I look back over what's kind of approaching about 7 years now that we've been on this journey, don't underestimate kind of what an entrepreneur might be going through in the background building the business, because it's hard work to take that risk in the beginning and to ultimately do it, but it's also an amazing journey. You have to take a lot of people on the journey with you, and I kind of come back to this now and again. If I knew what I knew now, would I have done it again? And after all of the, how hard it's been, every day is amazing, but it's also challenging. I would have done it every single day. You learn so much in this type of role, and I'm so happy that I ultimately took that risk about 7 years ago to leave Goldman and do it. I can recommend it, but not for everyone.
And you keep developing into a larger T-shaped profile.
Yeah, exactly. I'm going to be the biggest T in the world.
Amazing. Thank you so much, Adam.
No, thanks for having me, Lloyd. It's been great.